What's up? It's October 27th again. um, all right, so we're catching up here, and this is a super important lecture, okay? Because this lecture is all about financial planning, okay? So this is 11th week, and the important thing to know about this lecture is that you guys can all do this on your own. Um, it's just learning the kind of vernacular, learning the different tricks, the different investment strategies that are out there. Um, you can go ahead and open up your own Vanguard account, Fidelity account. I kind of challenge you to do this right now. And then it's kind of like doing a video game where you learn how to invest in different types of kind of bundled stocks. That's the easiest way. They're called mutual funds, um, exchange traded funds. These are different strategies that you can use, and you can assign your risk, okay, in terms of the kind of funds you invest in, but you have total control of it, and that's the key aspect of it. You're not handing off all the money you've made as a businessman, or handing off all the money you've made as a gerontologist, or all the money you've made as an actor or an athlete to somebody else, because sadly, we live in a world where there are some people that will extort money, swindle money. They will embezzle money, not extort. Sorry, embezzle money and stuff like that, and then you're left with nothing. So my advice to you is to take control. Okay. Now that being said, many of you guys are going to become financial planners. Okay, because people are afraid of what they perceive to be a very complicated process of doing investing, which it isn't that complicated. Um, and so they just pass the baton to somebody else. Okay, and of course, the strategy of becoming a financial planner is that you say, "Hey, I know the best bundled stocks to invest in, and by me giving you the leg up on this, we're going to get the biggest return on your investment, and then I'll charge a fee for that sage advice that I have." Okay. Alrighty, so that's how that works. Now, so I'm going to go ahead and go into the lecture. I do want you to remember then that we do have, you just did CT2, which is good. And you saw how important it was to consider for people that, a large segments of our society don't have a lot of money, and how such a high percentage of their income goes towards healthcare costs. The next thing you have to do is your interview papers. So don't forget. Line up your grandparents if possible, your parents, whatever. I guess you guys want to interview me. I'm 64, but and just and you ask that we give you core questions, okay, to ask, but also you can you can create your own questions as well too, and just make sure you follow the directions. So let's go into this week's assignments. Okay. All right, and also when you scroll down here, the other thing that's coming is, don't forget, we do have the exam, the second midterm on Friday, November 13th. Okay, cool. So let's scroll down here. So the last lecture was just kind of a primer about what what it is people have to think about in terms of investing, and had to do with partitioning their assets between income, which is Social Security for a lot of people, returns on investments, 401ks, individual retirement accounts, things like that, and then of course your real estate package. What we're going to look at here is in week 11 is um, Social Security, as well as the investments you're going to make. So this is your retirement planning. Okay. Alrighty. So like I said, this is right here the wheelhouse of all of our business majors in this class. Okay. So this is something you really, really, really should begin to understand. Alrighty. Okay. So I'm starting here with what I call shock and awe. Okay, this is in one of the readings down below. It's one of the graphs. The statistics are kind of unsettling. This was a 2018 study, estimated that households where the members were between 50 and 55 years of age, the median, so that's if we lined everybody up and looked at the person in the middle of our country, okay, the account balance was under $8,000. It's mind-boggling, you know, that you're at that age and you only have $8,000 that you can really rely upon. Okay, and then they looked at people even closer to retirement between 55 and 61. Again, the median was just 17, which is just crazy, crazy. Okay, the average of the mean is higher, like I said, but that's skewed by super savers, like the top 400 wealthiest people in our country. Okay, so we see that 21% of Americans have nothing saved at all at the time of retirement. Okay, hoping that their Social Security benefit will be adequate. However, okay, this is the average Social Security benefit. Okay, just shy of $1,500 a month, just shy of 17,532 a month. That's actually the exact a year. So that's really hardly enough to rely upon, especially as we just learned from your CT2 that healthcare, out-of-pocket healthcare expenses are on average about $10,000 a year. Right, so you're left then with $7,000 about to cover life expenses, which is just insane. Okay, so in this assignment, we want to start thinking about the different mechanisms you have available to you. Okay, we're going to talk to you about 401ks, 403b programs. Okay, these are strategies. 401k is for the private sector. 403b, REFE, work for the public sector. Tax deferred individual retirement accounts called IRAs. Okay, and Roth IRAs. Okay, and these are designed really for young investors like you guys. Okay. Tell you straight up, okay, tax deferred means you invest the money now, and then when you start, let's say I was 20 and I invest the money into my IRA, and then when I turn 70, I start pulling money out of the IRA for my living expenses. That's when I pay the taxes on it. Okay, and the assumption is that your expenses are going to be lower when you get older, and so you're going to spend less money, and it'll be at a lower tax bracket. Okay. The reason the Roth IRAs are good, my boys have both set up Roth IRAs in Fidelity accounts. Okay. For young people, is you're not making a lot of money right now. Okay, and so it's all the tax bracket you are, what percentage of your income goes to Uncle Sam and the state of California for taxes. Okay, so you want to be right now because you're not making a lot of money, you're at a very low percentage. Okay, so what you do is you pay the taxes on the money now with a Roth IRA. So you're only making 20 grand a year, so the taxable rate is not going to be much. So now when you pull it out when you're 70 and it's compounded and it's worth, $500,000, you don't pay any tax on it then. So that's a pretty fair bet, and that's what you should be doing. All right. Okay. All right. So you guys are all really technologically savvy, So I am what I'm saying is I don't think there's any reason why you need to be hiring a money manager, an investment strategist, an investment counselor, etc., because you can learn this on your own. Okay, and all you need to do is just go ahead and open up your own account with Vanguard and Fidelity. Just take $1,000 here, $1,000 there. Start playing around. Okay. All right. So going back to the basics, that everything that we all rely upon because we all pay our Social Security taxes. Okay. When we work, we're going to look at the Social Security benefit. So at full retirement age, okay, which would be 66.667 years of age, the maximum Social Security benefit is $3,011 a month. Okay, so that comes out to $36,132 per year at the full retirement age, as of 2020. Okay. So what the federal government wants is they don't want people tapping into their Social Security benefit early. They want you to do it later. They want you to keep working. Okay, it's better for them, better for you. Okay, that means you'll tap into it for a shorter period of time, and financially, that's a better situation for them. So what they do is they create an incentive. Okay, and that incentive is for example, is if you wait till 70 years of age, your benefit is going to be 30% above what it would have been if you had the traditional 66.7 years of age retirement. Okay, all right. So you're going to go then to in this example from $3,011 a month to $3,790 a month just by waiting till you're age 70. Okay. All right. So this right here are some links to the planners. Okay. So and you can use the go ahead and look at it. Use the example of people that were born in this age in this period of our history. Okay. Okay. So this right here goes through the exact policy of the government in terms of retirement. All right. So when we look at early retirement, okay. Let's say you decide you want to draw Social Security at the earliest possible time at age 62. Okay. So that's going to be 30% less. So there's a disincentive to start early there by the government. Then what if if you were to get it at 66.7? So if we look right here, okay, the way it's calculated, and you can go into this calculator right in here, okay, to figure this out. The benefits reduce 0.5% for each month before this normal retirement age of 66.7, up to 36 months. So that'll be the earliest time you can do it. Okay. So a major disincentive. Okay. All right. If the number of months exceeds 36, then the benefit is further reduced. Okay, by 0.5% per month. So they really don't want you to do this. Okay. All right. So I said right here, okay, for example, if the number of reduction months is 60, all right, months, 5 years too early, then you're going to see, like I said, a 30% reduction in your Social Security benefit, all right. The flip side, okay, is, don't forget, by delaying, it's the same concept, but in the opposite direction. So if you wait till age 70, you're up there increasing it by 30%. Okay. All right. So this is a pretty simple article right here, this Motley Fool article, 2019, and it talks about what you can do in terms of your retirement investments right now. All right. So first of all, definitely do the 401k because you can invest a lot more than you can annually versus an IRA or a Roth IRA. Those are just government rules. And the Motley Fool article spells it out, and I also have created an Excel spreadsheet. Okay, so I talk about everything that it's all laid out right here, in text. Okay, so if we look here, like with a 401k, okay, all right, so the matching contribution that I can make personally, okay, not the individual contribution I can make personally when I'm under age 50 is $19,500 a year. Okay. After age 50, okay, I can bump it. It's called a catch up to $26,000 a year. So, all right, so that's an additional $6,500. The government wants you to invest in your retirement. So this is why they've created this catch up contribution concept. Okay. All right, but the total of my 401k, let's say if I have matching funds, okay, from my employer, which I did for many years from USC, you can see that it jumps, okay, from 1950 to $57,000 per year. So that's a huge incentive to find a company to work for that does matching, because you can really, really, really invest in your retirement. So it's like you're making, an additional, 40 grand a year. All right. All right. And again, this reflects the catch-up fund with the $6,500 right there. Okay. Awesome. So it's way, way, way cool. All right, so that's my defined contribution plan, all right? 401k, as is an IRA, as is a Roth IRA, okay? But these are not through the workplace. These are just individual accounts that you take your money and do it. And there are more substantial limits on that we'll talk about here in a sec. Defined pension plan, okay, we saw that in the previous readings. What a pension plan is this is guaranteed income, okay? For you, because you've worked for the public sector, meaning you work for as a fireman, work for city government, work congressman, et cetera, et cetera. There are limitations, okay? For the most part, when you die, that money also goes away with it unless you set up a separate account for that. You can also invest your own money, okay, like the 401k and a 403b. It operates like a 401k, but it's just for public sector jobs, okay? Okay. Never roll your 401k or an IRA, and these are all the reasons right here. Okay, so I want you to kind of look at these papers. The Motley Fool reiterates what I've said here, the article. If you look at this, it just goes over, clear statements why you wouldn't want to do this. First of all, fees are very low for 401ks. IRAs have higher fees. There's earlier penalty-free access, so I can access my money out of my 401k if I need to, whereas if I do with an IRA, I pay a big fee for that, big fine, okay? There's low to no cost guidance from Fidelity and Vanguard, okay? I have very strong protection against lawsuits going after my 401k, which I don't have with my IRA. I can borrow against my 401k funds, which I cannot do with my IRA, okay? And I have a lot more investment options, and it's very simple. So anyways, don't do it, right? Don't do it. All right, so this right here is the table that I was talking about. And I also have it down here if you want to take a look at that as well, okay? Alrighty, so it's just a copy of Excel, and that's actually in a PowerPoint slide. And so I'll just go ahead and bump that in, okay? Here it comes. Okay, let's open this sucker up. Yeah, it's just a little easier to look at, all right? And we'll go like this. Okay, so this is a 401k versus an IRA and a Roth IRA. So this is what you can do right now, okay? So annually you can put $6,000 in. That's the absolute limit, okay? You would pay the taxes on this out of the blocks, but you would not pay taxes on it when you pull the money out when you retire, all right? If you're older than 50, you have a $1,000 catch-up contribution, so not that much money. Same drill for an IRA, okay? All right, so an IRA, remember, you're putting the money in and you're going to pay taxes on it when you pull it out. That's the difference between these two, okay? And a $1,000 catch-up. You see here with my 401k, my personal amount of money I can put in is $19,500. My catch-up is an additional $6,500 to puts me at $26,000. Plus, remember, there was that difference. I can put a lot more in if my company is willing to match those funds. All right. So this kind of just goes over what you would invest in. So when you open up your Fidelity accounts, which I hope you guys do, all right, you can invest in mutual funds right here, and these are just bundles of stocks, lots and lots of companies. They're called equities, and bonds. And bonds is a loan that you make to a company or to the government. Okay, hundreds to thousands of companies. Dow Jones Industrial is a giant mutual fund. S&P 500, Nasdaq, but there are hundreds and hundreds of these. Okay. They usually have a minimum investment dollar amount that you have to put in, okay? And at the end of the day, there's a reassessment, okay? With exchange traded funds, okay, it's like you're playing a game. It's like you're buying individual stocks, but you're not, Okay, so yeah, same concept of these equities and bundled stocks and bonds. Okay, same kind of mutual funds that we're talking about here. Okay, but the only difference is there's this real-time trading instead of looking at things at the end of the day. So some people find that more fun. Okay, what is a bond? Like I said, it's a loan. Okay, and it has a guaranteed dollar amount of return. All right. And it's based on the purchase price. Okay, so this percent return you're always going to get, whatever that is. Say it's $500 a year, then that's what you're going to get. Okay, you'll often hear things called the yield. Okay, that is the percentage that is applied to the base value of the bond, so that you always get your $500. Okay, so it's bad when you hear that the yields have gone up because they've had to apply a higher percentage to the base because the value of your bond went down in order to get that saved $500. It's bad. That's bad because if the value of bond stays down, if you ever want to sell it, you're going to sell it at a loss. Okay. Alrighty. Bond values as they tend to go down and yields go up. So so we have to apply a higher percentage to get that same $500 return when prime interest rates are going up by the government. That means the lending rate by the government is going up. Okay, so those are just some kind of rules of thumb. Okay. All right. Let's get out of that. All right, we'll go back in here. All right, and what else do we have here? Okay, lastly, we have down here an annuity. Okay, hey, there's my son right in the middle of my lecture. Way to go, buddy. Say hi, Matt. Yeah, right, cool. He's hungry because he's taking classes right now too, just like all you guys. All right. All right. He's trying to be quiet, but he is being quiet, but he's just got to go get his stuff. Okay. Welcome to the world of Zoom. This is even Zoom. This is just me doing my recordings. Okay. What is an annuity? So this is where you take your assets, all right, and you give your assets to an insurance company, and the insurance company says, "I'm going to give you a guaranteed amount of money every month when you retire until the day you die." Okay, guaranteed. All right. They're also leveraging it on this concept, on the fact that you're going to die young, and they hope that we'll keep it. Okay, now that's an extreme case. There are different types of annuities that are out there. So some people like these annuities. Okay, so this is right here. This is a discussion why annuities are bad. Super high fees. The insurance companies charge you ungodly fees, and the other thing is you don't have the flexibility to invest your money in things you might want to. It's stuck in this insurance company. All right, to get it back from them, huge fees. Okay, um, but that being said, some people like this kind of security of knowing they're going to get a monthly payment. Okay. It's a reliable income, okay, that you get through the annuity, and that's in contrast to having to manage and spend your IRAs or your 401ks. Okay, so people, sometimes they kind of lose their perspective. Next to know, they're paying all this money, paying out, and next to know, it's like, oh my God, where's my IRA, my 401k? It's all gone because I took too many trips to Europe or whatever. So when you have an annuity, that's not going to happen because you're going to get this monthly allowance basically. Okay. All righty. So yeah, so this right here explains the different annuities. This is a cool little article. I just put in this link. Like I said, it just describes what happens when you take your assets and make an annuity. Okay, so let's say I took out a bunch of money out of my house and I gave it to this insurance company that was going to guarantee my payments. Not a good strategy. Okay. But this talks about the worst case scenario annuity. Let's say if you give your money to the insurance company and you die after annuitizing, taking that money and giving it to the insurance company, there's no refund of your principal. Okay, under this option, which is tragic. Okay. But they incentivize this by saying we're going to give you more months more per month than we would under these other options, where even if you die, there's a percentage that will go to designated beneficiaries. Okay, all right. So that's what that's all about. All right. So then we get into this right here, and it's an article worth reading. And this is something that you should sit down and discuss financial planning with your parents, okay, and management of the financial planning. Because in this particular example, this New York Times article, this poor woman, what happened was she didn't take a close look, okay, at the trading that was going on in terms of her father's investments, and he got taken, which means that she got taken in the end as well. Okay. All right. Discussion. So this goes back to what I was talking about originally, guys. It's kind of scary. Okay. So we're looking right here. Okay. So this is by age group. All right. The amount of money that has been invested, like I said, through an IRA, Roth IRA, 401k, for retirement. Okay, and naturally at 32 to 37 years of age, you see there's not a whole lot, but I was already rocking and rolling by then, believe me, because my money would then compound. Okay, 8% return every year. You know, it's pretty straightforward. Here, let's take a look here. All right, so I'm just gonna. All right, let's get a calculator here. All right, so let's say, you know, I'm 35 years of age. Okay. And I invest, I'm just going to say $10,000. 1, 2, 3. All right. All right. So, you know, I think it's pretty good to suggest that when I look at my Fidelity account, that I'm making get an 8% return on that every year. All right. So that would be times 1.08. Okay. All right. So look, I made $800 that first year. Okay. That same money by year 2. All right. Let's see what happens, times 1.08. So this is compound interest, okay? Look at that, all right? So it's going up. Let's do by year 3, all right? Times 1.08 equals, okay? All right, let's see what it looks like by 10 years times year 4, okay? Times 1.08 times year 5 times 1.08. All right, year 6 times 1.08. Year 7 times 1.09. Year 8 times 1.09 times 1.09. And lastly, times 1.09. Right. I don't think I even did that right, but it's all right. Look at how much money I made. Okay, so that's the idea of compounding. Okay, all right. So when you look at individuals right here, we see that we're looking at, say, the oldest age group, 56 to 61. We see that in 2013, only $17,000 had been invested. Okay, so it's kind of scary. So I'm asking you guys to come up with some ideas to improve your retirement strategies right in here. All right, guys. Very cool. So hopefully I've convinced you that you need to become your own investment strategist. Peace.